Welcome back to the Deep Dive. Today, we are pulling you right into the economic heartbeat of the Midwest.
We are talking about the Indianapolis housing market.
We've got a massive stack of sources here, a really comprehensive 2025 year in review, plus a detailed forecast for 2026.
Yeah, we're pulling from MyBor, Zillow, Redfin, and of course the heavy hitters at the National Association of Realtors.
So our mission for this deep dive is to tackle a core question, really a paradox. How did Indianapolis become what our sources are calling a beacon of stability and opportunity?
Especially when the national market was just, swinging wildly.
Exactly. High interest rates, all that fluctuation.
Yeah.
Why did Indy stand so firm? And what does that mean for you if you're planning a move or an investment in 2026?
It's a great question, and it's crucial to start with the foundational context because Indy's success, it wasn't magic. It was just simple economics.
Affordability.
Pure affordability. That was the core advantage. Even when mortgage rates were soaring nationally, Indianapolis housing costs stayed roughly 10% below the U.S. average.
Which is a huge buffer.
Yeah, a massive buffer. That lower barrier to entry, it meant the market could absorb shocks much better than, say, a coastal metro. And you add to that sustained local economic strength.
We're talking real job growth.
Robust, diversified job growth, particularly in sectors like tech and healthcare. Those local drivers just bet. They mitigated the shock, those elevated national mortgage rates that really defined 2025.
Okay, so let's unpack this. We have to start with 2025, which, the source material is clear. This was the definitive transition year.
Oh, absolutely.
If you were selling a house in 2023, you held all the cards. The frenzy was deafening.
Okay.
But 2025 is when the fever broke.
It ran out of steam completely. The whole dynamic shifted from you must offer sight unseen to, let's take a breath and actually evaluate.
And the data, the metrics, they absolutely back this up.
100%.
So let's dive into those key metrics because this is where Indy's stability narrative is really written. Home prices.
Right.
The growth was, modest is the word. MyBor data shows the median sales price got to around, $273,000 by Q3?
That's right, around $273,000. And that reflects only about a 3% year-over-year increase.
Just 3%. And you have to remember the headwinds we were facing.
That 3% is so telling. All through 2025, national mortgage rates were stubbornly high, averaging between 6.5 and 7%.
That pinch was real.
It was. And while Indy had strong in-migration, the cost of borrowing just fundamentally changed what buyers were willing to pay.
Okay, but here's where it gets really interesting for the listener because this is the part of the market that changed the most dramatically. Inventory.
The inventory surge, yes.
We saw this significant jump in listings, up 20 to 30% in many key areas compared to just the year before.
And more choices for buyers means fewer bidding wars. It's that simple.
The pressure was just off.
The consequence was immediate. Homes just sat on the market longer. We're talking an average of between 15 and 49 days.
Which might sound like a long time if you sold a house in 3 days back in 2022.
Right, but it's actually a very healthy sign of the market normalizing.
And this increased time on the market, it really forced the seller's hands, didn't it? The data we pulled here is striking.
It is.
And this is the number you need to remember about 2025. A full 56% of listings saw price cuts.
That 56% figure, it's not just a number. It is the definitive sign that the Great Housing Reset had already started locally in Indy.
You mean sellers had to face reality?
They had to swallow the fact that the frenzied days were over. They couldn't stick to those aggressive pricing strategies anymore. And ironically, that quick self-correction is what protected the market from stalling out completely.
But wait, that's a sharp question here. If sellers were slashing prices over half the time, why did the median price still grow by 3%? Why didn't it drop?
That's a great point. The growth really came from two places. First, you still had strong demand for the lowest priced homes, which were moving fast.
The entry-level market.
Exactly.
Yeah.
And second, there was still very solid demand for new construction and luxury homes in those high-amenity suburbs. They held their value.
And what about different property types?
Well, single-family homes still dominated the conversation, of course. But other categories started to gain traction. Multifamily units, for example.
Because rents were climbing.
Rents were up 2 to 4%. So for an investor, those properties suddenly look much more appealing from a cash flow perspective. And on the commercial side, industrial real estate warehouses, logistics hubs that saw really powerful growth.
The Amazon effect.
The Amazon effect, yeah, and other e-commerce players just expanding their massive Midwest footprint.
Okay, so that brings us out of the broad metro-level data and into the city itself.
Yeah.
Indianapolis isn't monolithic, right? And the sources show its neighborhoods evolve very differently in 2025.
Driven heavily by those lifestyle shifts, where people wanted to work, where they wanted to socialize.
Let's start with the urban core. You've got consistent demand in a place like Broad Ripple.
Always a favorite for young professionals.
It's all about the walkability, that cultural scene. And those factors kept median prices remarkably high, hovering between, $325,000 and $345,000.
Then you have the revitalization stories, like Fountain Square, a totally different flavor of demand.
Right. Still attracting millennials, but they're looking for those affordable rehab opportunities. The median price point there is much lower, around $250,000.
And the driver there wasn't just price. It was strategic investment. Revitalization grants, new mixed-use projects. It signals future growth.
And we also saw emerging value spots. Meridian-Kessler comes to mind, that mix of historic charm with modern updates.
Hitting that sweet spot, yeah, with medians around $280,000. But the real centers of appreciation, they were still in the suburbs.
The suburban rings, Fishers, Carmel, Avon, top schools, family amenities.
And critically, that growing population of remote and hybrid workers.
It's fascinating. The work-from-home revolution just completely repositioned the importance of a school district, didn't it?
It really did. That's where the serious investment moved. Fishers, for example, saw higher price growth, around 4%. That tells you demand for that quality suburban life didn't slow down.
And Carmel.
Carmel maintained its focus on luxury builds. It appeals to that higher-end buyer looking for space and amenities.
So what about the areas that maybe struggled a bit or plateaued in 2025?
The downtown cores generally saw slower sales. And the reason is pretty simple: geography.
Fewer commuters.
Fewer people commuting to an office means less demand for a home tied to the central business district. But, the future does look brighter there. Revitalization grants are sparking interest in new mixed-use developments.
So looking back, 2025 really rewarded the savvy players, the buyers who knew they finally had some leverage.
And the sellers who staged their homes effectively and, most importantly, priced them right from the start. It was a year of necessary market maturity.
That sets the stage perfectly for what everyone's waiting for. 2026, we are now talking about what the sources call the Great Housing Reset.
And this next chapter is all about two things: anticipated federal rate cuts and a massive amount of pent-up demand.
The rate cuts are the key. That change in the cost of borrowing is the single most important variable for the next year.
Absolutely. After the recent Fed moves, we're expecting mortgage rates to dip into that 6.0 to 6.3% range.
Which may not sound like a huge drop from 7%.
But it is. Going from 7% to, say, 6.2% unlocks significant monthly buying power. It's going to pull thousands of buyers who were sidelined in 2025 right back into the market.
And locally, that translates to robust but still controlled growth. The forecast is for appreciation of 2 to 4% in 2026.
And for those top-tier suburbs we just discussed, that growth could even hit a higher range, maybe 5 to 7%.
And more importantly, activity. A huge uptick in activity. We're expecting somewhere between 4 and 14% more transactions.
Right, so the total number of homes changing hands is going up. Inventory should stabilize, probably still favoring buyers a little bit early in the year before things heat up.
So if we connect this to the national picture, Indy seems poised to outperform.
For sure. Nationally, the forecasts are kind of all over the place. Realtor.com is predicting a very modest 1.7% uptick in sales.
That's tiny.
It is. But then NAR, the National Association of Realtors, they're anticipating a much more robust 14% surge in sales volume with 4% price growth.
Indy's outperformance, it just comes back to that core affordability and stability.
It does. Plus, those continuous infrastructure investments, expanded transit, downtown projects. The city has the fundamentals to support the demand that lower rates are about to unleash.
What about for investors? Is the commercial market still split?
It is. Industrial real estate, riding that e-commerce wave, is going to continue to thrive. But the real story for local investors is multifamily.
The rental market.
That segment is set to boom. Zoning reforms, infrastructure upgrades, they're making these properties ideal for long-term holds. Demand for quality, affordable rentals is only going up.
Okay, so let's wrap this up with the playbook, the action plan. For you, the listener, what are the practical steps for 2026, whether you're buying, selling, or investing?
For buyers, the message is simple. Get ready to act as rates drop. The rate lock is your most powerful tool.
So get pre-approved now.
Pre-approve immediately. Lock in the best rate you can before the market fully reacts to the next Fed move.
And where should they be looking?
To maximize value, target those emerging areas. Our sources point to a place like Castleton as a prime example. It's seeing investment, but still has accessible pricing.
And don't forget the incentives.
Never. Leverage every program you can. First-time buyer programs through the Indiana Housing Authority can offer up to $10,000 in down payment assistance. That can be the difference maker.
Now for sellers, the days of just throwing a sign in the yard are over, but you can still do very well.
You can, but you have to be strategic. The advice is to list early. Get on the market in Q1 to beat that heavy spring competition.
And you had to put in the work.
You do. Invest in curb appeal. Get a pre-inspection done. This removes uncertainty for the buyer and can lead to a 5 to 10% faster sale. And you have to be realistic on price.
No more wishful thinking.
Price it 2 to 5% below your comps initially to generate buzz and get quick deals. Don't chase the top dollar and end up with one of those price cuts later on.
Finally, for the investors looking to capitalize, what's the play for 2026?
Focus squarely on multifamily units, especially in those revitalization zones like Fountain Square and the surrounding areas. The returns are there because rent demand is just so high.
What kind of returns are we talking?
The projections are showing solid cap rates. That's your rate of return based on the property's income, somewhere in the 6 to 8% range.
6 to 8% is a very robust return in this environment.
It is. And while inflation is still a national risk, Indy's diversified economy, with those major tech hubs like Infosys and the huge healthcare system, it provides a layer of resilience that many other markets just don't have.
It insulates the investment.
Perfectly said.
So what does this all mean for you? We've journeyed from 2025's market adjustment marked by high inventory and that striking 56% price cut statistic to this anticipated sweet spot of 2026.
A year fueled by lower rates and consistent local job growth.
Indianapolis is clearly positioned to outperform the national averages. It's maintaining stability while offering real opportunity. But succeeding here requires strategic planning based on these local insights, not just national headlines.
Which really raises an important question for you to consider as you plan your next move. The national forecast, especially from NAR, sees this very strong 14% surge in sales coming, suggesting a return to high volatility. Indianapolis, though, is projected for 4 to 14% more transactions, but a more modest 2 to 4% price increase. So given Indy's history as this beacon of controlled stability, will the market truly follow that high-end national volatility? Or will its affordability and commitment to steady growth ensure it just maintains a conservative pace, outperforming the nation without those extreme peaks and valleys we see elsewhere? That's the tension you need to mull over as you finalize your strategy.